we go through the different scenarios and I will explain how you can trade it purely based on Elliott Waves. Right? So no other tools, no support resistance, order blocks, horizontal levels, because you don't need it. But the approach is exactly the same because you can trade the waves as they are. You can use directional bias as well. I mean, in the end, Elliott Waves gives you a directional bias and you can use that to then find an entry in the direction of the directional bias according to your plan. But if Elliott Waves is your plan, here we go. So price creates a high. Now we all know what happened here at the high. I don't have a level here or an area of resistance. But from an Elliott Wave point of view and Kuhn's theory, trend and turn methodology, we were looking for price to move down. Reason being, and this is, right, this is Elliott Waves, it's just simplified, right, Kuhn's theory as well. Price is slowing down, right, slowing down. You have a couple of 1-2s over here or 1-2. Price slows down, overlap returns. We go from vertical to more horizontal. Volume increased, decreases as price is overlapping here. That means that you are not looking too long here. You're looking too short. Now, when you're considering a short, there's two Elliott Wave scenarios. You're either looking for a 1, 2, 3, 4, 5. Now, if we look at a wave 4 target here, taken from the low to the high, then your minimum short target is 122.1K. That would be a minimum target. Now, where's your stop loss going to be? Well, you don't know. Maybe you would have gotten another 4 or 5, right? But by all means, you do know that you're ending a structure. So you don't expect price to move up too high anymore. Right? And that's something you can keep in mind with a stop loss. Arguably, you can also like put your stop price starts moving down, creates a high. You can put it above the high. And then every time you get stopped, you create another high and then short that one. Or you're going to use a little bit of like room to play with in case price curves a little bit more and then goes down. And then you're safe. Right? This is just style, but in the end, you're looking for a short, no? Minimum target is the 0.236 for a wave 4. The 382, still a target, 05 as well. However, the 05 would have overlap with wave 1, so that doesn't work. That's your invalidation. Now, in this particular scenario, you're looking for a short, either 4 or wave C. A, B, C. Wave C generally takes out the end of A. So you know that if you take a short here, your maximum target is the low of A. Your minimum target is the 0.382. From a time perspective, right? So now we go into time. Wave 4 is more important because generally a wave 4 is similar in size or longer in time, like similar in size or longer than time compared to wave 2. So if this is a 1, 2, 3, we look for a 4 and a 5, then we can hold on to a short position till at least the 0.382, which is a minimum target, sitting on the 9th of October, 10 a.m., which means that at that time, you've been in this short, if you would short the exact high, just for, high to the 382, that is 2 days and 16 hours. Right? But that's a minimum target for a wave 4. Preferably, as mentioned, wave 4 is similar in size to 2 or longer, meaning the 1-to-1 is your common target area. Which means that if you're entering a short, looking for a potential 4 or a wave C, then you preferably hold on to that short till at least around the 13th of October. And you just let it go. Because when you know Elliott Waves, you realize that if you are looking at a flat A, B, and C, wave C is commonly a fast, quick structure. An impulse is generally a quick move. You expect a couple 1-2s and then a 3. If price was going to move sideways, you get a move down, looking for a move up, looking for another move down, and then eventually you go. Now, if you enter somewhere here, right, in like somewhere here in this area, you'll be able to exit at break even or exit at small profits, take a TP, whatever, by the time this range has proven to be corrective. You will be able to get out of this trade at break even or a little bit of profit. Because now, as price is moving sideways in a corrective structure, you realize, hey, we're not looking at a motive wave now. But even if the beginning here looks like a 3-waver, that is not a get out of the short signal. If you trade the 4-hour or daily time frame, that is, maybe locally, if you trade like low time frame, you're like, wait, this is a 3, let me just close here. Okay, fine. But if you do local trading, you might just enter here, stop loss here, and then look for the move down, close at the low, right? But we're now talking about more like arguably a swing trade in this case. If price moves down in a 3 or looks like a 3-wave structure, you're either looking for another local 4 and another 5, right? So you can keep that in mind with the stop. And as a minimum for a larger range, you're looking for price to move to like the 13th of October. So you would expect a 3, and then another 3. And by that time, if price makes this move up, you're like, okay, we're looking at a corrective structure, time to get out in the next leg over here. Little bit of profit, cool, right? Covers the fees, covers the time you've been in this trade and whatnot, and then you get out. So that is the short position. Now, of course, eventually price then moves towards the downside, but you don't know. You're looking for a C or a 4, but you don't know what. You have to wait and see what the local price action brings. What you do know is that if it's a wave 4, you want to be in the trade till around the 13th of October, at least. But then price moves down here on the 10th of October. So now you're like, beautiful, right? Because it's either wave 4 or wave C. Well, we get wave C. Now price is moving down, 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 down. And eventually it takes out this low. Now you got yourself a swing trade. Now initially you're looking for a wave A, a wave B, and a wave C. As price is falling here, you're looking at an impulse to the downside. So naturally, that's some 2s. You're looking for some 4 5s. Now there might be a truncation here, 1, 2, 3, and then a 4 and a 5. Truncation of the big wicks, very volatile movements. But then you get another leg up and eventually another leg down. Now, when trading Elliott Waves, this is taste, personal preference, but generally you want to ride the 3 and then exit in the 4 5s or when you expect the 4 5s to happen. But now you realize that the minimum target for an expanded flat, a running flat would end wave C here, but most commonly, running flat is rare, most commonly C takes out the lows. So basically your target would be take out the lows. And that could be a brilliant exit area where you're not gonna wait for 4s and 5s. You're just exiting at the minimum target for a flat wave C, which then is that low. And then you get out with, well, depending on your stop loss, a nice risk to reward ratio, right? Of course, in hindsight, you know this RR is nice. Even if you had your stop all the way here at 130K, you have an RR of 1, 2, 3. Of course, you don't know that the moment you take it. It could have been an RR of 0.6 or 1 to 1 if you go to the 382 and you go sideways in a wave 4. Right? But still, profit is profit. No? And you can measure your stop loss, put it above. You see your curving, so you don't expect too much more like high price action. Okay, so that is with regards to this scenario. Now, what follows then is that you get this move towards the upside. So now we're like, okay, 1, 2, 3, 4, 5, we can end something here. But is this a wave C? Is this a wave A? Is this a wave 1? Well, it depends on the move to the upside. And this was quite, not gonna lie, this was quite a tricky structure. And the main reason it was tricky is because of the potential of an expanding diagonal. The thing is, and this is probabilities, expanding diagonals are just very rare structures. I mean, you see them, but they remain very rare structures. So that makes the move towards the upside a bit problematic and arguably more corrective than motive. If this is an impulse to the upside, we can only really do it as a 1, 2, 3, 4, 5 correction. And then here you again like a 1, 2, 3, 4, 5 wave structure and move towards the upside. Otherwise, you're going to look for WX and then ABC, and that's your Y. And you're going to look at corrective structures. So, okay, we identified that the bulls are basically stuck with a expanding diagonal. So if you're an analyst and you see an expanding diagonal, you may be like, well, looks more corrective than it does motive. Okay, well, if that's the case, you have two main areas of interest. From an Elliott wave point of view, a retracement in a potential wave 2 or B commonly retraces to either wave 4 or wave 2. Those are your main areas of interest. You take a Fibonacci from the high to the low. And also, of course, this could be, at the time, this can be a wave 2, this can be a wave B, this can even be a wave X, where the flat is a W, and you are looking at a wave X. But that means you're still looking for a Y down. So the bias, and there you go, the bias is the same. Directional bias is the same. These scenarios are different, right? Scenarios are different. It can be an ABC, can be a 1, 2, 3, can be a multi 1, 2, can be a WXY, but your bias is this looks corrective, we look for another move down. And then depending on the move to the downside, you can adjust your position. You can manage your position. So, okay, we get this move to the upside. We toggle on the fibs and we toggle on all of the fibs. There we go. Minimum target for retracement of an impulse, the 382. Even if we would like consider a W, X, and a Y, you take it from the start of W, a Fibonacci here, start of W to the end of the impulse. And then you can see here that price moved to the golden pocket, right? If you're considering W and then X and Y, right, for a wave, a longer, like if you're looking at the wave X, preferably at a longer corrective structure, but your bias is the same, so you can enter shorts, of course, right? But anyway, let's use the impulse fibs now. So here we go. The 0.5 common target area, common retracement area starts with the 382. Most common area is the 05 to the 786, rare target 886. So when focusing on purely Elliott waves, your preferred area of interest for shorts is this area. You can see it's quite a big area. Like you can do the following things, right? Like with regards to execution, you can say, okay, as the 05 is the lowest target of the common target area, I enter there and my stop loss is above the high. My minimum target is the low, or if we focus on a more like maybe a WX and a Y, maybe we create a higher low, but I need time to wait and see this because a WXY will take a lot of time. Flat, you then get a wave X and then eventually a Y, which is going to be very like, you know, either a zigzag to the downside, by the way, zigzag or a triangle, probably not a flat because W is a flat. So you're still looking for another leg to the downside. And because this is a flat over here, right, in a sideways WXY, preferably a zigzag or a triangle is preferred in wave Y. But this, of course, is this is an entry. No? Minimum at the 0.5 because you know Elliott waves, you know the common target area, you know that you are at wave 4 here as well, 0.5 at the end of wave 4, that's fine. And then this could be your stop. However, you can also say my stop is at the 886 because it's a rare retracement target. You can also say my stop is at the 786 because that's like generally the maximum of your common target, put it a little bit above. What you can also do is put it here in the middle of the move to the downside. You have a gap over here, right? And this is, I mean, it's difficult not to use the knowledge when you have it, but according to like gap knowledge, if you start closing candles in this gap, you generally fill the gap. But still, even without using gap knowledge, if you realize this is a wave 4 and this is the maximum of your wave 4, and you do understand that a retracement of an impulse commonly goes to either wave 4 or wave 2, then naturally the stop can be between the two pivots, right? So, okay, we can put it over here, right? Somewhere inside the golden pocket, but also in the middle of this move down. And now your stop is shorter. What you can also do is put it on the golden pocket. And if price would move up, you're just going to stack. You're going to do this. Right? Maybe you go to wave 2. Perfect. And now you can put the stop here on the 886 or above the high. Right? And you look for another retracement. So your bias is set. Based on the move to the upside, you are like, well, it looks like a corrective structure. Looking for a move to the downside. I have numerous options to enter. purely based on Elliott Waves. You don't need to know anything else than Elliott Waves here. You can enter at the 05, right? Stop, up to you. I just explained it. But if you use this like a more like stacking method, or like the stop of the one is hit, which then triggers the entry of the other. Stop is hit, entry of the other, right? Because you still expect another move towards the downside. So if the stop here is hit, -1%. If the stop here is hit, -1%. Okay, so we're down 2%. Price moves to this range. That is the entry. Well, I'm still expecting a move to the downside, and the risk to reward ratio of this structure, right, 1% risk, preferably of course higher than 2, so you cover these two. You're going to be at least break even if you lose these two. And then of course the potential of your profit based on your bias. Of course, if price just continues to the upside and does this, well, then the analysis was wrong and you just lost 3%. But that's the risk. It depends on your trading style. You can have only one position and then put your stop loss maybe at the like the high here, all-time high, 886. Maybe you're going to put it at the wave 2 area, because you realize, well, wave 4 or wave 2, if wave 4 fails, then the next entry is at wave 2. Okay, you have one loss here, maybe another one if price would continue. But if this is corrective to the upside and you identify this correctly, the probability is higher to move down. Okay. Interesting. So then price moves to the downside. The rest is just management, of course. You observe how price is moving towards the downside. If you are looking at a wave B or a wave 2, you always want this low to be taken here. That's always going to be a minimum target. So it could be interesting to, of course, take something off once you take out the low. And if one is looking for a larger W, X, and a Y, then in general, if this is a 3, this was quite a short structure for an X. Preferably wave X would be a little bit longer if we take a fib time from the start to the end of the potential W, then in that case. And you can see that the 0.382 fib time is all the way here. Preferably wave X finishes after this line. So preferably a wave X would have been longer. And if this is a 3-wave structure, you're basically looking for a larger sideways structure before eventually you still get another leg down. So you again, if you're looking at a larger corrective structure, you can still hold on for a longer period of time because of time. With a B or a C, this is a minimum target. So price then, of course, moves towards the downside, takes out that low, very nice, and oops, creates a low over here. Right, at that time, you're probably going to be well managed, likely took a TP1, stop loss break even, fees are covered at least, maybe a bit of profit. Don't forget to pay yourself when you're on the right side. And then price creates another move towards the upside. It touches the 886 here, taken from the low to the high. 886 touch equals very likely to continue the trend and take out this low. Price moves up, takes out the low. Directional bias with the 886, also known as the K8 principle, plays out. In Kuhn's theory, that is. And then you get this move to the downside, which was a very clear impulse. 1, 2, 1, 2, 3, 4, 5, 4, 5. Create a wave 5 at the low on top of support if you used additional support. But if you don't use additional support, this was counted as a wave 5. Guess what you're going to do in a wave 5? You want to enter in 1-2s if you're trading the lower time frames, right? You want to enter in the 1-2s. You identify the 886, you're interested in looking for short positions. That's your bias. But here you have your 1-2s, 3, 4, 5, 4, 5. Entries, exits. Once you start moving in a wave 5, here you're looking for price to turn around. So of course I explained the short position. You can do the exact same methodology over here as well as this corrective or motive. Touch the 886, okay, that gives us information, right? Then also you can see that locally this looks like an impulse, 1, 2, 3, 4, 5, which means that locally, if you are looking for short positions, because the 886 is touched, so it's interesting to look for downside, you're going to look 1, 2, you get another move up, 3, 4, and 5. Once you start slowing down here, let's go to a 1-hour time frame. So over here, put up the volume as well. So you have a wave 1, a wave 2, and a 3, 4, 5 arguably, right? 3-wave structure to the upside, 1, 2, 3, 4, 5. Price here starts to slow down. Area of interest, because if this is a 5-wave structure, this over here, look at the size of the range as well. No? You're starting to look at a wave 4 now. Highest volume in this local move to the upside is here. If looking at an impulse, 1, 2, 3, 4, 5, preferably you get another move down, another high on decreasing volume, which you got here. So you realize you're in a wave 4 situation, you expect another leg up in a wave 5, right? So arguably you could be like, well, in that particular case, let me just short the, like the moment you take out the end of your wave 3, that's a possibility. No? You're also at some structural resistance here. You have a range here, then you have this range here, which serves as an order block. Actually, not sure if it's, yeah, so serves as an order block. So you could put your stop, there we go again. Now I'm using another tool. I'm so used to that as well, but still, we're not using another tool. If this is an impulse to the downside, this is your wave 4, this is your final leg, that's wave 5. This would be your wave 4, that would be your wave 2. If this is wave 4, price tends to retrace to wave 4 or wave 2 of a lower degree. You put your stop just above the end of your wave 4 here before you got that sharper leg down in wave 5. And then your minimum target is taking out the low. That's at least a 1 to 125 RR. And then depending on the move to the downside, you follow up. But then what you see is you see this. And now you're like 1, 2, 1, 2, 3. Okay, I'm looking for at least 4, 5, 4, 5. Right, so you can hold. Of course, maybe TP1, stop loss break even, manage well, and then you can hold. And the moment you're looking for a 5, so in other words, the moment price takes out this low here, that's the moment you're moving into wave 5 territory. But then locally, you see this move down, move up, 1, 2, price accelerates, volume increasing. That's your 3. You don't yet have a wave 4 or a wave 5. So you're still waiting for another range and another drop. That's your 4. This is your wave 5 of 5, which means that the moment you're in 5 of 5, that's your long area basically here. Right? This is where you start to get interested in, okay, from an Elliott Wave point of view, I am now looking to enter long positions and close the shorts. Yeah. Purely based on Elliott Waves. You don't need any other level of support or resistance down here. This is purely reading the chart. Range, sharp move down, impulse, that's what we're looking for. You always need a 4, you always need a 5. Right? And I can go down to lower time frames because of course it's just a matter of Elliott Wave degrees, that even in wave 5, of wave 5, right? You can once again count an impulse here then. 1, 2, 1, 2, 3, 4, 5, 4, 5, right? You could even go that low, right? Like you open the volume, you see, okay, we have a high volume here. Well, in that case, this looks very volatile. That's likely your wave 3. Look for wave 4s and 5s, still take out the low on decreasing volume. Okay, perfect, boom, entry. Stop loss, somewhere. No? You're looking for a move to end. Right, so you can put your stop loss wherever. Maybe you can use structure, extensions, Fibonacci, whatnot. And you're looking for price to move towards the upside. That's your bias, okay? So you're looking at a wave 5. By then, I mean, from a swing trading point of view, as generally you want to ride the wave 3, because the moment you move down, this is important with regards to closing shorts. Like everyone has their own style, but when looking for an impulse, 1, 2's entry, 4, 5's exit. And like you don't know if sometimes the end of a 3 is also a C. This is where flexibility matters. So if you get a move down, this is an impulse. If you get a move down, this would be an ABC. Wave 3 common target is generally at least the 1.618. Wave C can also move to the 1.618. Wave C quite commonly has high volume as well, mimicking a wave 3. The main difference is that here you get a 4 and a 5, here you don't get a 4, price moves up. So naturally, when trading a short in an impulse in this example, the main area to close really would be the end of a 3. So you don't have to bother with the 4s and the 5s. The wave 4s can give new opportunities if proven corrective. So at the end of the 3, one could be interested to look for a long. Wave 4 targets on the chart, I'll go into the wave 4s in a second. And then you're looking for wave 5 later. If the move up is proven corrective, higher probability corrective structure, which means you got to keep an eye on the local time frames. But this is always a great area to exit because you'll be surprised that like it happens relatively often that you get a nice sharp move to the downside and then it stops, people think about an impulse, then it's an ABC and price reverses, and all your paper profits are gone. While your analysis was good, you are looking to end a wave 3, but because you're looking for a 4 and a 5, you hold on, because you're looking for that tiny bit, like 3 is generally the biggest wave. 5 is usually a smaller wave, right? If 2 waves are extended, it's commonly 3 and 5, not wave 1, that's very rare. But wave 5 would generally be a shorter movement. So is it worth it to hold on for all that time? Wave 4 is commonly the same time as a wave 2 or longer. You're going to go sideways, 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 sideways. You have enough time to observe this move and see if there's a potential for a re-entry. Or price moves up, and in that case, you closed at the low. So that is why I am a big fan of closing at the end of a 3 and then observe the force. And what I always say in my content as well is wait for a range to form, because the ranges will give you all the information that you need. Execute in the ranges, ride the impulsive moves. So anyway, we're at the end of our wave 3. 5-wave structure identified on the chart. And over here, right, even if you closed the short over here, that's fine as well. You don't need to ride it from the exact high to the exact low. It's about probabilities. If you identify this back at the time, 1, 2, 1, 2, 3, 4, 5, 4, and 5, this is your 5, you close here, that's perfect as well. That's perfect as well. However, if you followed my content, then you realize that the moment price took out this low, I think that was actually mainly mentioned in the members, because I made a video that we're looking for price to still move up another time, which was then this move here. But I think I didn't update YouTube about, okay, because price took out the low, you're now looking for lower. Reason being, I mean, it's kind of like a soft hint made in the video that this was a higher probability corrective move to the downside, which means you're looking for another leg up. However, if price higher probability corrective move and you take out the low, it means that this whole structure is a higher probability corrective move, means the low is higher probability corrective, either wave B or wave X, means the move up is a higher probability corrective structure, wave C or wave Y, which actually means you're going to go for downside. So in other words, you're looking for a short in wave 4. And a wave 4 of a higher degree, as then you label this a wave 4. Wave 4 of a higher degree tends to retrace to the price action of wave 4 of a lower degree. It doesn't surpass it, at least not significantly, maybe wicked, but that's about it. So you can enter a short, stop above the range, look for price to move down, you follow up with this structure, 1, 2, 3, 4, and then you get your wave 5. And then there you go, right? You got yourself a trade. So do this, 1 to 2 RR, perfect. Yeah, we're not looking here at 1 to 10, 1 to 100 RR, but you can get them. You can get the 1 to 10 RRs and that sort of stuff. They are there, just not in this example, but they're absolutely there. But it's not like 1 to 100 SMC, right? This is Elliott Wave trading. This is showing you what's possible purely based on the waves. And then we get to the low. Okay, we realize we're ending something. We can enter a long, have a flexible stop loss here. We realize that's likely your wave 3 because of the volume. Look for another low, decreasing volume, likely a wave 5. Maybe this wave 5 was going to be a bit longer, right? Maybe this wave 5 was going to be a bit longer on the lower time frames and go down a bit further. Maybe at your stop here, oh shit, stop touched. Okay, cool, enter new position, maybe a bit of a larger stop because you're looking for a move towards the upside. So okay, we enter a position somewhere here, absolutely beautiful. And then you're looking for price to move up. But now you realize that your minimum target is going to be the wave 4. Because on a, there we go, on a daily time frame, like higher time frame, your bear scenario is the impulse. And the minimum target for wave 4 in an impulse is the 0.236 minimum common target. So 86.9K, which is most like 99 out of 100 times you touch for a wave 4 to 236. So that would be a minimum target for a move towards the upside. So then you have a stop, right? Wherever, imagine your stop was going to be below 80K, nice round number. You're going to have yourself about a 1 to 2 RR at that moment. But then you also realize that if we're working on the wave 4, well, we compare wave 4 with wave 2, take a fib time from the start to the end of 2 to the end of wave 3. Preferably, wave 4 is going to finish at least after the 0.382 fib time, which is the 23rd of November. So we realize that preferably we hold on to this position till after the 23rd of November. Or at least when we see a potential three-wave structure to the upside. You never know, wave 4 might also be a flat, and then you have a wave A, you get a wave B and a C, and then it might stop you out, you get a wave C up. Well, in that case, if you realize this is a corrective move, then the bottom over here, this one, gives you a long position. And you can trade the wave C up. That is what I explained here in my video. I don't know, I think I put it on like 20th of November. I made a video explaining as well why this was a great long opportunity for a move up, but you can check that one out, which was based on Elliott Waves as well, by the way, because it had to do with volume and structure. As on the lower time frames here, volume slowed down, structure went from vertical to horizontal. That's what we like to see at the end of motive wave structures in order for a bounce back up. Anyway, so then we have the 0.382, but we also realize that a wave 4 preferably finishes around the 1-to-1 or after the 1-to-1, as wave 4 is commonly similar to 2 or larger. So here's the 1-to-1. There we go. On the 27th of November, 5 p.m. is Central European time. Currently, we made a high there. And if we're looking for a wave 4 in this particular scenario, it's not too bad of an idea to consider the potential of an exit. This over here, right, this move up, you can take a TP1 here and the price range moves up and then eventually a potential exit. You're in the 382.05 area, common target area for wave 4. The 382 is very, very common area. Also wave 4, again, wave 4 of a higher degree, right, retracing to the wave 4s of a lower degree. That's a common target area for a higher degree 4. Right? It's a guideline. So wave 4 of a higher degree tends to retrace to the wave 4 of a lower degree. This is your wave 4 of a lower degree. This is an even lower degree. But basically this area is your main area of interest, which is also below the invalidation for wave 4. Okay, very nice. So then you're basically done with this trade. Now, if price moves towards the upside, that's fine, because it's not about sniping the high or the low, and then, oh, we touched the invalidation. Oh, now I'm missing out. Oh, it went to all-time high. Oh, it went to 150K and I sniped the low and now I'm sad. That's not the right mindset. That is not the right mindset. You had yourself a banger opportunity here. You understand the rules, the guidelines of the wave 4s. You understand that 5 was likely ending here at that particular low. You're looking for the target area 4, minimum target reach, but then you look at time, you're like, well, we didn't yet reach the 1-to-1. You can focus on the local structure, which I'll go on in a second, to the 1-hour time frame, and you realize that, hey, we're looking for higher, we're looking for higher. Even in this range, we were still looking for higher, and then price made this high, right? So, okay, that's a solid trade, and there's going to be a new opportunity. Even if price would move towards the upside, you should be happy, right? Because if your probabilities are bearish on the daily here, right, and you're looking for a wave 4, which is a long opportunity, you just had a great opportunity here, right? You had a nice trade. And then if you're trading a wave 4 now, then quite simply, you'd be interested in looking for a short. This is where analyzing the lower time frames help, though, to get a better feeling of what's going on. But as mentioned, the probabilities in my content are higher for corrective structure up till proven otherwise, with like a multi-1-2 or a larger impulse. So we take the short position calculator thingy here. Price moves towards the upside. If you've been keeping up to date with my content, you realize that we were looking for higher, higher, higher every time. So now price here created a high, and yeah, I mean, it's a nice area between the 382 and the 05 in the lower degree wave 4. Perfect. You know, this range here, gotta say, we were looking still for another move towards the upside. So, okay, cool, that plays out. If we're then looking for a wave 4, over here of a larger impulse to the downside, this area in general, 382.05, is a nice area. It's a nice area. You're at the lower degree wave 4 as well, so nice area. Your stop would then generally be the 0.618 if you would follow the wave 4. This is a guideline, which is basically comes from me because it's not written in the book, but this is more like a Koens thing. So my I have a couple of things that added 2 cents to Elliott Waves, and one of them is the 618. It's so rare for a wave 4 to touch a 618 and still be a wave 4 that you might as well use it as an invalidation, because in 99 out of the 100 times, you're going to be correct. You're going to be absolutely correct. I discussed this with Prechter over dinner in February when I was in America visiting him as well. So Robert Prechter, the author of the Elliott Wave Principle, one second, which is this book. Let me switch to the cam, right? Elliott Wave Principle, Frost and Prechter. It's like usually seen as a bit of like a Bible. And this was the day I was with Mr. Prechter having dinner. So he wrote something in the book. And yeah, so when we discussed, when we were talking, we're talking everything like live, Elliott Waves, business, whatnot. But I also spoke to him about the 618, and he completely agrees that the 618 would be incredibly deep for a wave 4. And it's not something he sees, right, in the markets. So cool, we can use that theory to put our invalidation above. You can also say, well, this is wave 4 of a lower degree. I don't really want wave 4 of a lower degree past the blue wave 4. I might also just put it over here, right? Now this is another lower degree wave 4. If you put it above that one, you're at the 618. But there's different like reasons to put a stop somewhere. But it's all based on pure Elliott Wave theory, what we're doing here. So okay, you're interested, you got your short, you can put your stop above the 4, 618. Maybe you just put your stop above the high, because now you're like, well, we can finish something here, which is true. So maybe you're just going to put your stop above the high. And if price is taking out the high, well, is it going to be a motive wave? What's the volume doing? You can observe. Maybe you're going to add another one here, invalidation 618. If that's touched, okay, we're likely not looking for a 5 to the downside. But of course, with the profit from a move down here and a move towards the upside, having losses, it's part of the game. Right? It's part of the game. Okay, so in this scenario, and we're still in a daily time frame, this would be like a setup, right? Maybe shorter stop or longer, doesn't matter. Depends on what you want. And then your minimum target is taking out the low. Wave 5 to the downside should be an impulse. So naturally, you're looking for 1, 2, 3, 4, 5 wave move. So now you can observe an impulse to the downside, and you're going to close, preferably, I mean, it's up to you, but the close would be at the end of 5. So if you can count a 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, you want to enter once you start moving in that 5, and then CBA getting the whole 5, because it's not about getting the whole 5, it's about getting out in the 5. So the moment you get an impulse down, couple of 1, 2s, 3, couple of 4, 5, blah, 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 that's your exit area. No? And then, of course, people can compound on lower time frames with a potential short if you can read the market. Just had to cut the video here as I wanted to add this because I forgot about this during my recording. So if one would consider a short here, according to Elliott Wave theory, and one is looking for a wave 5 towards the downside here. Now, if price moves towards the upside and touches the 0.618, then this would be an invalidation. So minus 1%, absolutely fine. But in return, you get more clarity because now the probabilities increase that this is a 3-wave structure to the downside. If this becomes a higher probability 3-wave structure to the downside, the probabilities are higher to eventually take out the high at a later stage. Now then we have to observe this move to the upside. Is this move up then a higher probability corrective or motive wave? If the move towards the upside is a higher probability 5-wave structure, it makes life easy, as then you're looking for a 3-wave retracement, and that always provides a long opportunity, and you're looking for price to move up, at least take out the end of the 5-wave move towards the upside with the potential of continuation. A great example of exactly this was here. So if I use the replay mode, and we go over here into a lower time frame, and price made a low here at like 57. Now imagine you did not long this low, you're waiting for a 5-wave move towards the upside. Okay, well, price creates a nice impulse to the upside here. 1, 2, 1, 2, 3, 4, 5, 4, 5, right? Typical impulse, overlap, sharp overlap, and then you're looking for price to turn around. There's many opportunities over here, but I want to talk about one main opportunity, and that is the retracement, which is a three-wave structure. After this move down, you get a very long range. This range is over 6 times the size of this move down, increasing the probabilities that that move down and this range are not related to one another, increasing probabilities to move up. And this is a three-wave, lots of information in a short period of time. But besides this, you can take a Fibonacci again from the low to the high of this move, toggle on the fibs, 0.5 touched, and then again you can do the same thing as I did when looking for opportunities to the downside earlier in the video. You can just put your stop somewhere you're comfortable, and eventually your minimum target is taking out the high, and price range, and eventually it moves up and takes out the high. And that is basically what you would like to see on the chart right now as well. So if we go back here, if you get a 5-wave move towards the upside here, an impulsive structure, you're looking for a retracement, and that is going to be an opportunity. If the move towards the upside here, however, is a corrective structure, higher probability corrective structure, right? Price moves up, but it's a higher probability corrective move. Well, in that case, the probabilities are higher that you're going to create a larger corrective movement, right? You could still take out the low, double zigzag structures, or a larger sideways corrective structure, right? Also a possibility, but we'll have to take it as it comes. It just means that on a very high time frame, swing longs or investments become interesting again, but preferably one waits for a little bit of structure locally to get a bit more confidence in certain positions. But then again, locally, there's many different positions to be had. It's just that if price moves up and invalidates an impulse to the downside by moving back into the ranges here, at least you know that the bias is up. High time frame bias, right? Weekly bias, daily time frame bias is up. We're looking for price to take out the all-time high at some stage. But then depending on the structure to the upside, we know if we're going to be dealing with a larger ranging structure, a larger retracement, or if we get a 5 up and a 3 down and a very clear opportunity. Okay, let's now continue with the rest of the video. And then you're looking for price to move down. And then the same thing is then basically repeat. Try to long the end of the 5, then aim to short the potential of the end of 4. Your bullish scenario, if price would come down here, your bullish scenario is A, B, 1, 2, 3, 4, 5, C. That's your bullish scenario. So price can do this or price does that. According to probabilities, if you take a trend-based SIP from the high, the start to the end of a potential A to the end of a potential B, toggle on the 1.618, then you can see that if you take out this low, you're likely moving beyond the 1.618, lowest probabilities for an ABC. If I go to log, you surely move beyond the 1.618. Lowest probabilities for an ABC increases probabilities for a impulse to the downside. So if you get down here, probabilities increase for another 4 and 5. But it doesn't necessarily mean it's very interesting to keep holding on a short for a potential 4, because this is, again, a sideways range, and there will be a new opportunity if you can find them. So, okay, very, very nice. Then we go to the 1-hour time frame. So this was weekend price action here. I kind of like CBA because we realize with the wave 4 minimum target that 86 point something was at least the minimum target. So any longs taken here, minimum target is at least going up there. So, okay. Price moves towards the upside, and this is stuff where I explained this in previous morning routine videos. I think I'm going to make this video public as well for education purposes. So price moves towards the upside, and this was all done also again like in real time in the membership group in morning routines. I explained this move towards the upside even in the content where we can quite clearly see an impulse, right, to the upside here. If you look at this structure, right, we don't have to look at this here. We don't need to look at this. Right? We see this move towards the upside. This is quite clearly an impulse. So you're probably looking for either an A, B, and a C, or 1, 2, 3, 4, 5. Now what we can see, volume, 50-minute time frame, maybe go down a little bit. Go here, focus on this move towards the upside here. So what can we see? This is like very simplistic 1, 2s, 3, 4, 5s. That's an impulse. Now you have Elliott Wave theory, which is very complex, lots of rules and guidelines. Every 1-2 should be counted. You should check all the retracements. You should know how many 1-2s are here. You get your 3, got to count all the wave 4s and 5s and the detail and la la la. And then you have Koen's theory, which is what I invented based on my experience. And we're going to have a free PDF on the theory coming out. But in a nutshell, it simplifies things to such a degree that you can read the chart without any of the detail, no need to count. What do we see here? We see overlap. We see a sharp move to the upside, acceleration. Look at the curvature. We're moving from horizontal to vertical, right? Volume increasing as price is moving up. And then we start to see overlap again. Price overlapping as it moves up, decreasing volume. This candle here, never been taken, moving up, decreasing volume, lots of overlap. In other words, we're looking for wave 4-5s here in an impulse, right? In Elliott Wave terminology. In other words, we're looking for price to turn around. In a nutshell. Now, if this is your start from an Elliott Wave point of view, so this is basically also, this is the OSO sequence I have. So overlap, sharp, overlap, and then you're looking for price to turn around in a nutshell. But commonly, if you are looking at wave 4-5s and you're looking at an impulse, then your wave 4s, as they are commonly longer than wave 2s or similar in size, you would generally expect your 4-5 structure to be longer in time than your 1-2 structure. So you could even take a Fibonacci time from the start to, I mean, where are we gonna, let's put it to the low over here, right? And then this is basically where your wave 3 would end and the 4 starts. So you would preferably move up till at least after that line. So you would then generally only, like, you know, if you consider a short position in this particular case, you'd be interested to do so after the vertical line, preferably. So yeah, okay, then we see prices moving up, overlap, a big mess. And maybe you need a few positions. If you have very short stops, right, that's up to you and your risk management. If you prefer shorter stops or larger stops, but you're looking for price to turn around. So you can have, sorry, a bit of a larger stop. You can, of course, also use previous market structure again, right? This would be a wave 4. Here you can see there's quite a bit of a gap. Now you do realize that if price is closing candles in a gap, I mean, this is gap theory again, I suppose, but in a wave 3 from a structural point of view, there's just not a lot of structure here. So you would expect to move through it. So you can also say, okay, you know what? I'm going to move my stop up, put it inside this section over here, look for a retracement to the downside. Okay. And then if this would be an impulse in a 1, 2, 3, 4, 5, your minimum target, there we go again, from the low to the high, 0.382, you have the 236, 382, the 05, you can observe the structure, 618, invalidation. Ooh, invalidation touched for a wave 4, okay. If you take it according to those particular fibs, right? Because this is a mess, we don't want to count this really in detail, but you can count this as a 1 if you see my recent content. Flat, that's a W, ABC, ending diagonal in C, that's your X, zigzag structure, that's your wave Y. This is your 1, 2, then you have a 3, 4, 5. Wave 4 does not overlap with wave 1 in this particular case, right? And the lowest point in wave 2 is the W. Take a fib from the low to the high of 3, doesn't touch the 618, right? So there's always that wiggle room. So pop, we have a short position. Very, very nice. Okay, now price moves towards the downside. You can identify this. Is this corrective? Is this motive, right? And then eventually manage accordingly. We get a retracement into a lower degree wave 4. This one, because that's your 3. And price moves towards the upside. Now that price moved towards the upside here, you can do the same thing because it definitely looks like an impulse. So again, you can look for shorts, but anyway, let's focus on the move up as per the content as well. The moment price takes out this high, and of course you took TPs and stuff, this is never a losing position. Price takes out the high, you cannot end something here. You cannot end something here. If you're looking for a 4, like, you know, for the daily impulse, you cannot end something here. Because now you either look at a 5, you look for a 3 and a 5, or you're going to consider WXYs here. where wave X would be either a flat ABC, and then you get Y, or W, X, Y, and X, and then you get Y. But in both cases, you're still looking for another leg up. And that's what I explained in my content, which was recorded, I think, I don't know exactly. I think, where was price? Somewhere here. I got to check. 25th or something, I think, like 24th, 25th. You can check the content. Basically, we were saying we're looking for another move up. Either we'll move up here or we move up here. But we're not looking for a flat at the moment, because a flat would be a 3, 3, 5. But the moment you take out this high, like this now needs to be WX ABC in a Y before it's an A valid for a flat A, B, and C. So you're still looking for higher. You're not looking for a flat wave B in a larger flat. Very low probabilities that happens. So at the moment, we're looking for either a shallow retracement, W, X, A, B, C, Y, or 5, 3, 5. It can be B's or 2's, they can be shallow. But W, A, B, C, W, X, and then A, B, C, and a Y, or 5, 3, 5, or W, X, Y. But guess what? When trading, if you would trade a WXY, and I literally in the morning, so every morning I make this was actually supposed to be a morning routine video. I now transferred the length, and the info is valid for YouTube as well. But every morning I make a morning routine video where I go through the waves, do my levels, educate, show my way, show my thinking, approach, like this is usually a morning routine video, but I think, it answers a question on YouTube. I'll put it online, but this is like standard. Commonly, these videos, however, are between 20 and 40 minutes because, it's a morning routine. It takes time, but this is definitely a longer one. So if you count a WXY, this is your invalidation. Because initially you're going to be like 3, 3, 5, look for a 3 and a 5, which means we have to observe the retracement here. If this is a higher probability corrective structure, there might be something here. So I said in the morning routine video that I recorded as price was in this range, I said from a trading point of view, there could be an opportunity here, right? And one might have to stop at the low, or there's going to be an opportunity here. Well, that's fine. If price would hit the stop loss here, no problem. We just observe the structure to the downside and look for an opportunity here and still look for a move up, which then covers the stop, minus 1%, plus additional profit. That's the goal. So your first opportunity would be here. Now, is this range to the downside corrective? Because there's always the potential of a B and a C to the downside in then a larger X. Okay, we are aware. So we analyze this move. Now, this structure to the downside cannot be counted as a motive wave. Sure, it looks like a 5, but it can't be a 5, an impulse. 1, 2, 3, 4, 5 impulse, overlap, invalid. You can't count an expanding diagonal here because 5 is shorter than a 3. You cannot count a contracting diagonal here because the trend lines are expanding. Invalidation, plus 4 is larger than 2, invalidation. Probabilities are higher, this is corrective. Therefore, probabilities are higher. You're looking for price to take out that high. Now, in the video I posted yesterday, I then had some example counts. Maybe we had a WXY and we look for price to move up. Or you look at a more sideways structure and price moves up. Perfect. At least we know higher to move up. That's the bias. Guess what? Ta-ta, ta-ta, and ta-da. Pure Elliott Waves. We don't need additional tools. We don't need nada, nothing, order flow, horizontal lines, pure counting. Here you can see corrective move down. Okay, cool. We're looking for price to move up, and then eventually it moved up. Either it happened here or it happened here, but the bias is the same. This may turn into a loss if price would move to the downside, right? But then because the bias is up, there's going to be another opportunity. And you're not looking for a flat here because price took out this high. So you're not looking for price to take out that low unless it's a wave X in a WXY. But it's not common for wave X's to take that low. So naturally, if price would come down further, you would have another entry somewhere here. You can put your stop below the low or a little bit higher, and depending on the move to the downside, and you're looking for another leg up, right? But you can see how much knowledge I'm using to get to such plans. So anyway, price moved towards the upside, beautiful, and then you just follow the move. And this was explained in the video yesterday. Price moves towards the upside, very short. What happens? Bias is taking out the low, it takes out, or sorry, the high, takes out the high on an increasing amount of volume. The first thing you're going to think is either ABC or 1, 2, 3. Well, quite clearly, like if this is a 5, you're looking initially for an impulse to the upside. In that case, you have some 1, 2s here, you get a 3. You're at least looking for some wave 4s and then wave 5s. And guess what? That's your entry area. This over here, pop, 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 pop. That's your exit area. Very nice. We do this, exit in the 4 5s. Done. Right? Okay. Which also then means, by the way, there's again a potential short opportunity, but you get the point. I already explained potential short opportunities here because of the 4-hour time frame, the daily time frame analysis, right, with the 618. So there's that. And then you can analyze this range here, which we did as well. And then you figure out probabilities higher. This is corrective. This was during the live stream a couple days ago. This is either an ABC or 1, 2, 3, 4, 5. We never got a 4 and a 5. Price touched the 618, invalidates wave 4, played out, took out the highs soon after. Continues the range, but because your probabilities, because your like bias is set in this is most likely a corrective structure, you can look for long entries, minimum target, take out this high. But then you got to wait for a little bit of a risk to reward ratio. Well, what then happens is price continues up and touches the 886. The 886 K8 principle, it's common for price to retrace back in the range of this move to the upside. But it is a lot less common for price to take out this low. So if price comes back to the downside and you're happy with an RR, there might be a potential position here where the stop loss is below that low and you're looking for price to take out the high. Yeah, maybe a 1 to 1, 1 to 2, depends on where you enter. No? Or you want to give yourself a bit of flexibility, right? At least you do realize, because this is not a 5, you're not looking for a 5, 3, 5 ABC. This is higher probability of 3. And price here moved up, touched the 0.9. There's the potential for a regular flat, A, B, 1, 2, 3, 4, 5 in a C. Regular flat usually then moves just below the low over here, right? For then an A, B, C. Wave C generally doesn't extend in a regular flat. So that then being said, if we're looking for a long position, preferably we do that at the lower end. We realize the 886 is touched. Okay, cool. We can enter a position. We can have the stop just like maybe a bit further away below this range over here. Minimum target is the high, 1 to 1. Minimum to take out the high. And of course, we expect price to take out the high, preferably with an impulse. Price continues, like this can be a TP1. Stop loss goes break even. Then observe the move. And price continues. And then you can have a TP2, TP3, whatever, because then this local move up here would be 1, 2, 3, 4, 5. Anyway, that's management, but you get the point. You get the point. And then even here, yesterday I explained why the probabilities were higher here to move up as well. That was 3-minute time frame stuff. Oops. Move down. We take a fib time from the start to the end. If we're looking at a trend change, we would count a wave 1 or a wave wave 1, of course, preferably, not like an ABC, unless you end up in a diagonal, but at least you need a 5-wave move down, corrective move up, and go. But the corrective move up is very rarely longer than 6 times the size of the impulse to the downside. You can see that this high was made between the 5 and the 6 fib time, meaning if this high is taken, you're likely looking for price to take out this high next. So the moment this high is taken, your bias is bullish, you're looking for price to take out this high. Didn't really give another retracement for a scalp position, but maybe this would be a scalp by itself in your case. It depends on your risk profile. Price then moves up, and then on the lower time frames, you can see here a bit of range. That would be your 4, 1, 2, 3, 4, 5. And then basically this range, if we want to end something at this high, this range would be a WXY, and price moves up. WXY in a wave 4, finish the move up, that's your wave 5, and then in a bearish structure, that can be a wave Y, that can be your ABC, and then again, this doesn't matter. So I regularly show multiple scenarios in my content, but it's the same bias, the same expected price movement. So maybe that's a lesson for me. Maybe I have to adjust, but wow, what a video. So that is that. Now it's weekend. Let price do its thing. You know, there might be an opportunity at the daily naked point of control, but I mean, again, now okay, I'm using another tool, but still, I do use these tools, so I talk about the tools. So there might be something there. We'll see. I'm not really like, this is low time frame stuff. I do prefer 1 hour time frame. That's a nice. I love the 1 hour. Both in analysis, you know, and what I showed everything here. 1 hour is really, really nice. Just give it a little bit of time. But then again, we spoke about execution. If looking for an impulse, wave 4, yeah, sure, it might be finished there. And then if one manages well, we'll see what happens now. So, whoo, this is a big video on the channel. I don't really think this video is going to do very well from a viewing perspective as like the amount of viewers, because the video is so long. It's like a Netflix short movie or something. But hey, if you want to learn Elliott Waves, you probably watch this till the end. And yeah, just thank you. Thank you for watching this video. I really try my best to explain things in the best way possible, help you guys, answer the questions. Of course, positive feedback is always very welcome. And thanks for watching. Thank you for supporting the channel. Thanks for subscribing. And hopefully you just find this useful on the Saturday morning here. It's pretty much noon now already, but and I have a guest coming in a couple minutes, so it's actually a good time to go. So yeah, thank you for watching. I don't really have my traditional outro. I could. So let me just do it. There we go. End screen is coming in 3, 2, 1. Boom. So I hope this video was helpful or valuable to you. On the left, you see a video on the simplest way to use and trade Elliott Waves without even counting. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott Waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye-bye.